A truck driver named Bill sat across from me during an audit when I was an IRS agent. He was absolutely convinced he'd done everything right. He had every receipt organized, every travel log maintained. There was just one problem. The tax rule he had been relying on for years didn't exist. I'm Andrew Bosserman, former IRS agent turned IRS defense attorney. Today, we're going to bust 8 common tax myths I see that destroy taxpayers. Myths that cost real people, real business owners, real money. Misconception number 1 is that I can deduct all my meals if they're business related. And this is the one that got Bill. He drove locally. His route, he would just drive a few hours away, then drive a few hours back. He was home every night and deducted thousands in meal expenses as a transportation worker. But here's the truth. Meal deductions for transportation workers require being away from home overnight. So just day trips don't qualify. Tax law looks at that like they would an office worker. They could just bring their lunch to work. Their meals aren't deductible. The broader rule is that meals are generally personal expenses. To deduct them as business expenses, they must either be for business travel requiring an overnight stay or directly related to a business meeting with a documented business purpose, attendees, and connection to your work. The next few misconceptions I'm going to go over are traps that I often see many business owners make. First one is that my home office deduction is safe if I use this space sometimes for work. The truth is that the IRS requires exclusive and regular use. Your dining room table isn't going to count. But a dedicated room used only for business, that qualifies. Misconception number 3, I can deduct the full value of my car because I use it for business sometimes. The truth is you can only deduct a business use percentage, not personal use. And you need a contemporaneous mileage log, not just the year-end estimate. So log all your trips on a regular basis throughout the years. The moral of the story, I saw this mistake made plenty of times. People just didn't keep mileage logs, or at least the taxpayers I audited when I was an IRS agent. Misconception number 4, paying family members is always a legitimate deduction. It can be, but the pay must be reasonable and documented, and the work must be real, and also payroll must be handled correctly. The IRS is going to scrutinize family payments more heavily because they know oftentimes that people try to pay their kids, get the deduction, and is there really any real work going on? So you need to make sure real work's happening and it's all documented and done correctly. This next set of misconceptions are going to go into some tax filing misconceptions. So misconception number 5, the IRS won't find income I didn't report if there's no 1099. The truth is, if you're audited, the IRS will use bank deposit analysis, look at your cash inflows and outflows, and any third-party data matching they can find. So cash income is taxable, all of it, even if there's no paper trail. If you're audited, the IRS probably will find it. Misconception number 6, an extension gives me more time to pay my taxes. So the truth is that an extension gives you more time to file, but it does not extend the time to pay. Taxes are still due on April 15th, and penalties and interest accrue from that date, regardless of if you filed an extension or not. Misconception number 7, the IRS can't audit me after 3 years. So the 3-year statute of limitations generally applies to returns with fairly accurate income, but if you underreport your income by 25% or more, that statute extends to 6 years. If you committed fraud, there's no limit. So the general rule is correct, but as with most rules, there's always exceptions. Misconception number 8, I don't need to report income from my side hustle if it's under $600. The truth is the $600 threshold applies to reporting by the payer who paid you the money, not to your reporting obligation. So the general rule is that all income is taxable regardless of whether or not you get a 1099. And also oftentimes, you may not receive a 1099 for much larger payments. Either the payer just doesn't file one or maybe there's some exemption. So before I go, if you found this video valuable, I want to make sure you have everything you need to protect yourself from the IRS. That's why I'm giving away a free PDF copy of my book, The IRS Survival Guide, at theirssurvivalguide.com. So head there now, grab your copy, and arm yourself with every strategy in this book. Again, it's theirssurvivalguide.com, completely free, no strings attached. Don't wait until the IRS comes knocking. Get prepared today. So if this video helped you, please subscribe and share it with a business owner you know who needs to hear this, and I'll see you in the next video.